And on Friday, bonds were slightly weaker in the overnight, but were adding to losses moderately after the stronger than expected jobs data. MBS were down a quarter point real early. Stocks were up a big 56 points. 10-year was up 7 basis points. The 2-year Treasury yield jumped as much as 13 basis points to 3.92 before shifting back to around 3.9 this morning. Non-farm payrolls came in at 253,000 versus 183 estimate. It was 236,000 previously. Average earnings came in up 0.5% versus an up 0.3 forecast. Consumer credit came in at 16.5 versus 15.29 last time. So people are still spending money on credit. That's not going to work out well. Overall, this report shows that the Fed tightening policy has yet to slow down the labor market much, and obviously consumer credit is still running up. That said, average hourly earnings and the CPI are trending downward. Fed's currently preferred bond market signal is not the traditional spread between the 2-year Treasury rate and the 10-year rate. It's the near-term forward spread. This is the spread between the rate that the 3-month Treasury bill is expected to yield 18 months from now versus the current yield on the 3-month Treasury bill. And regrettably, that rate is as inverted as it's ever been at 190 basis points. Traders earlier this week wiped out bets on any further tightening by the Fed after Jerome Powell opened the door to a pause in hiking and the regional bank turmoil continued. While Powell appeared to keep the option of hikes on the table, the market has largely discounted that. Those hoping for Fed to cut rates in response to regional banking situation might be disappointed. Former Fed Governor Randy Kozner put it succinctly, "The Fed won't quit until the labor market quits." The regional banks got slammed again yesterday with Pacific West down 50% and Western Alliance down 38%. There was a piece in the Financial Times about Western Alliance supposedly exploring strategical alternatives, which the company denied. Given the strong liquidity of some of these banks, the rout in regional banks seems to be overdone. The regional banks are up pre-market today. The jobs report has come and gone without offering anything too terribly interesting as state of the labor market or the prevailing trading range. In fact, the non-farm payroll reaction actually reinforced the trading range by pushing yields squarely above 3.40 on the Treasury. With that, attention turns towards next week's CPI data to help shed light on the most likely direction of the eventual range breakout. That waiting game occurs against a backdrop of ongoing bank drama, which has proved itself to be just as much of a market mover as any other data. At the end of the day, stocks were up a big 75 points, MBS lost 12 basis points, and the 10-year was up 7. So at the end of the day, like we said, we are at 100.91, which puts us in the upper end of this range right here, bordered on the ceiling of a Fibonacci retracement 1 of 101.34, and the several floors down at around 100.8-ish. So that's where we're at for the week. I hope everybody had a great week and hope you have a great weekend. Check out some of our common sources of influences, which are our sponsor at wellthatmakesense.com, as well as all the ones you see here. Have a great weekend.